Welcome everyone to the Prosperitas Financial third quarter webinar. We are very excited to be back in this amazing studio, joined by CEO of Prosperitas Financial, Mr. Christopher Ingram.
Glad to be here, as usual.
I'm glad you're here because I'm excited to learn from you today on what we're diving into. All jokes aside, we have a lot to dive into. The third quarter was exciting. There were finally some changes for this year that we saw over the last 3 months, but I think most importantly, I don't want to see where we're going. So let's just dive into it. And this will be recorded, so if you do miss the beginning of it, that's fine. You can come back to it. Let's go ahead and pull up the agenda for what we're diving into today. So like I mentioned, Chris is going to help walk us through a lot of what's going on just in terms of a market overview. So what did we see? What have we seen year to date? One, most importantly, but aside from that, what did the third quarter look like in particular? Kind of some interesting things in certain sectors. We'll look at the international markets because that's a very relevant topic after the third quarter. We can't sit here and do a third quarter webinar and not talk about the election. So we will absolutely cover that, market valuations, and then last, the fifth, the icing on the cake here is something extremely important for all you business owners, and that's called ownership reporting. It's never been required, and you will absolutely want to make sure that you pay attention all the way through the end, because it's a pretty costly fine if you're a business owner and you're not paying attention to that. So make sure to stick around.
Yeah.
Chris, I'm going to let you kind of jump off for us and take us right into this first section of market review.
Okay. I promised Robert I'd wait for the most confusing slide in here, and then I'd hand it back to Robert and let him take over. So
I'm ready.
Let's talk about it. It was a very eventful third quarter, to say the least. There's some things we can learn from it, some things we can think about moving forward, but lots of information to share. So let's dive right into it, and let's look at our market review and talk about what happened in the third quarter. If you look in the upper left-hand corner, those are the indices, S&P 500, NASDAQ, Dow Jones, and the Bloomberg Aggregate Bond Index. A couple things to note that I think are interesting is look at the NASDAQ. NASDAQ was only up 2.76% over the third quarter. That's typically where you're going to find your tech stocks. So tech stocks kind of slowed down their run in the third quarter, and you saw dividend stocks and value companies kind of take the lead and charge on. And so you see that kind of in the Dow Jones there, up 8.7% in the third quarter. And then you look at the bond index, the Bloomberg Aggregate Bond Index up 5.2% in the third quarter. And if you look to the right of that, you know, year to date, the Bloomberg Aggregate Bond Index now up 4.45%. So what does that tell you? The ag was negative going into the third quarter, and really it was that third quarter that brought it into positive territory with the big run we saw in that third quarter. If you look at our models, and let's start with the stock series there, you're kind of going to see something similar. Look in that middle one, that tech and innovation portfolio, which if you look to the right, year to date up 42%, which has been a phenomenal performer throughout the year, but a relatively slow third quarter for the tech and innovation portfolio, up 2.3%. So again, seeing technology kind of take a back seat in the third quarter with a little bit of volatility there. And then drop down below that, man, that dividend portfolio that we have in those value dividend companies, 11.2% in the third quarter. So don't count out, value and dividend plays. Sometimes they might not be the headliner when things are really hot, but when things start to slow down and people get a little bit more conservative and are looking for value, typically at the tail end of a run in a bull market like this, people start looking for companies that make more sense and have better value to them. You're going to see those dividend stocks start to pick up, and that's exactly what we saw in the third quarter with that dividend portfolio now up north of 12% for the year. And then the top row, that stock portfolio up another 6.5% for the third quarter, up 24% year to date. So all portfolios in great shape going into the end of the third quarter, but we did see kind of a changing of the leadership when we went into the third quarter for sure. Go to the right of that in that core series. Great quarter for pretty much everything. Ultra aggressive growth up over 5%, all the way down to the bottom of that row. And I'll go all the way to the bottom and just point out that capital preservation fixed income only portfolio. That's what we refer to as our bond portfolio. No stocks in that portfolio, all fixed income and bonds make up that portfolio. And the third quarter, kind of like that Bloomberg aggregate bond index, up 3.7% in the third quarter and now up north of 7% for the year. So I've said it time and time again on a couple of these webinars. Bonds are really healthy and have been really healthy for a while now, and one of the healthiest bond markets I've seen in a while. Having a bond portfolio up north of 7% going into the fourth quarter, that is a very healthy bond portfolio and fixed income environment for sure.
Well, the one thing I'll point out, Chris, is in case this is your first Prosperitas Financial webinar that you're joining us for, one of the things that Chris has said since the beginning of the year is just wait. This capital preservation fund, so our most conservative portfolio, will do close to 7 or 8% for the year. And here we are.
Man, you're going to tee me up as some kind of soothsayer here.
I mean,
the writing was on the wall, folks. I mean, it's not hard to see. The portfolio yields about 5.5% for the year, closer to 6% actually. But I've said as interest rates go down, or the anticipation of interest rates going down, that adds value to the underlying securities or bonds within the portfolio. So my thought process with that was we were going to get a percentage point or two of capital appreciation in the portfolio, and then we were going to get the interest on top of it, which, do the math, that puts us somewhere in that 7 to 8% range, which right now, it looks like we might even do a little bit better than that actually by the end of the year. So we'll see how the rest of the year plays out.
Yep, I like that.
Big news, Fed cuts. I was going to throw this one at Robert.
I know.
Take it.
I was ready.
No, I'll run with this one. So anticipation all year has been, when are we going to get our first Fed rate cut? And it's been a while now since we've seen the Fed actually reducing interest rates. And what this slide is basically showing us is that leading up to the Fed rate cut that we got this quarter, the anticipation and really what the majority of the market thought we were going to get was a 25 basis point rate cut, so a quarter of a percentage point. You can see it says that as of July 30th, over 80% of the market was expecting 25 basis point cut. And the Fed came out on September 18th and doubled that. They gave us a 50 basis point, so a half a percentage point rate cut. So I don't know that it necessarily surprised people, because as we got closer, you got more grumblings of possibly getting a 50 basis point cut. But I think, the majority of us were in the camp of thinking 25 basis points was what we were going to get. And surprised we ended up getting 50 basis points instead. If you've listened to me for probably going all the way back to 2018, you know that I'm not a huge Powell fan. I don't necessarily know that he's the best. There we go. I don't know that he's the best Fed chair that we've ever had. And I won't completely, roast him on our webinar here. But there are some questions of, why did we get 50 basis points instead of a 25 basis point cut? A lot of people were questioning whether that 50 basis points was some kind of indication that things were worse than what we thought they were. Why would he go so far so fast? Some people think he waited too long, and so he was trying to catch up. Lots of different reasons why people believe that he might have gone that direction. But I'm still in the camp that I thought 50 basis points was a little more than what we needed. I think we could have done 25 basis points and been fine. But that's not what he did. He gave us 50 basis points and we move on from there. I think we missed a slide. We might want to go. There we go. So what this slide is showing us, and something I want to kind of explain to people in a lot of different facets, right, is what happened to interest rates leading up to that Fed rate cut and what happened to interest rates after the rate cut. There's a saying in our business, it's called buy the rumor, sell the news. And what that means is we see it time and time again. I'll use another example. A lot of people will say, hey, there's a company out there that's going to give us a stock split. And everybody's really excited about the stock split. And they're expecting the stock to do really well after the stock split. And what ends up happening is the stock typically rallies prior to the stock split. And then when you get the stock split, the stock actually goes down, and people are always confused. Well, why did that happen? Why did the stock fall after the stock split? And I think what people misunderstand is the market is oftentimes what we call a leading indicator, not a lagging indicator. And so it's anticipating future events, and it tends to move ahead of that event. And so what this chart is showing you is the interest rate for the 10-year Treasury. And as you can see, going back to April, the interest rate on the 10-year Treasury started dropping well before that Fed rate cut, in anticipation of the fact that we were going to get a rate cut. So the markets already started adjusting ahead of time, and you saw interest rates start to come down leading up to that Fed announcement of what that rate cut would look like. A lot of that being that, people were just, the bond market itself was, locking in to some degree. This is where it gets a little confusing, but when you have a lot of buying of treasuries, that buying actually increases prices and interest rates drop. So prices and interest rates move the opposite direction of one another. And so what you got back in April, most likely, if you really think through it, is a lot of people, myself included, that went out there and said, hey, if interest rates are going to go down, we should probably lock in some of these interest rates now. So let's go buy some of these treasuries, let's lock in these interest rates. And so you saw a wave of activity in the market where people were out there buying treasuries. This increased the price, and it dropped the yield over that time period. And so you saw interest rates start to come down in anticipation of that Fed rate cut. And then boom, the Fed cuts this 50 basis point rate cut. And as you can see, the exact opposite of what people would think would happen happened after that rate cut, where you actually saw interest rates rise after the Fed gave us that 50 basis point rate cut. So it tends to get a little confusing there of, well, why are these things happening? So we're trying to explain a little bit of the rationale behind that and why you would see that happen. The other reason is that almost immediately after the Fed cut those rates, we had a couple of different economic indicators that came out that led us to believe that things were different than what we thought they were originally. So you saw an inflation number that came out that was a little bit hotter than expected after the rate cut. And you saw unemployment data came in that said the labor market was healthier than what we thought it would be. And so with that, people started to speculate that maybe Powell was a little rash with that 50 basis point cut and probably went a little too far, given the fact that things were kind of as good and stable as they are, and now started to get rumors or what do you want to call it, thinking that maybe we wouldn't get another rate cut before the end of the year. So now people are speculating, are we going to get another rate cut under those circumstances? And when people started questioning the path of the Fed moving forward, well, then you saw the market start to adjust and interest rates started to come back the other direction. So lots of moving parts to go in that, but it is a bit confusing. People don't often understand that the market is looking out to the future, not looking at what's happening today. And so sometimes you get this type of environment where things are moving prior to, or in a different direction than what you would actually think they're going to do. Mm-hmm. Hopefully I didn't confuse the heck out of everybody with that, but
we're
that's
good. Yeah, let's jog to the next slide because you touched on it for a second, and I'll let you take a little break here. To what Chris mentioned, when interest rates fall, bond prices tend to increase. And so a couple points other than just one validating what Chris said is what we're looking at here, but two, a bond is not one investment. There's different types and different grades of bonds. And in fact, we were just looking at a client's portfolio earlier today where this exact scenario came to fruition of we were talking to a prospect who is now a client of Prosperitas Financial. And this entire time speaking with the prospect, they had communicated how conservative they are. They're in their retirement years, well into their retirement years, and really just needed this portfolio to last them the rest of their life. And so they said, we're very conservative. We own almost 100% bonds. Well, we take over the client's portfolio and we help them take a look at what the actual holdings are. Come to find out, over 80% of these holdings were high yield bonds. And what that means is it's a bond portfolio that we're going to give up some of the quality of that institution, that government, or that corporation repaying us the bond, that the money that we're lending them, and in exchange for maybe taking on a little bit more risk with that bond selection, they're going to pay us a higher yield than maybe a bond for a healthier corporation or a healthier government, let's say a U.S. Treasury bond. So while they're going to benefit from higher yields on that bond, they're actually taking on more risk. And when you have someone that's a conservative investor and they think they're buying a bond and being as safe as possible, when we looked at what that portfolio did in 2022, it was actually down 15%. And so now 2022 was an outlier year, but for a bond portfolio to be down 15%, and especially for someone who doesn't have the bandwidth or the tolerance to take that much of a hit on their main investment portfolio, this is why we want to touch on this specific topic, because one, interest rates are falling. I shouldn't say falling, they're decreasing, and we got a bigger Fed rate cut than we were expecting, and that's why we've seen bond prices increase. But if you have bonds in your portfolio, it's very important to see what are your specific bond holdings, because you could have very high risk, high yield, but high risk bonds that you might be better off just holding certain equities or certain stocks, like Chris pointed out in this particular case. So worth noting.
Yeah. Yeah, there's a lot of information on this page that you're looking at, but at the end of the day, what you have to kind of understand is that the inverse relationship between interest rates and bond prices. And in a way that I like to explain it, that I think simplifies it the most, is that let's say that Robert came and bought a bond from me that was paying a 5% interest rate. Let's say he put $10,000 into it, $10,000 yielding a 5% interest rate. And then let's say about a year later, interest rates drop to 3%. And so another client comes to me and says, I want to put $10,000 into a bond. And I say, well, current market environment is going to pay you 3%. Now, Robert has this bond that's paying 5%. He still owns it. And so Robert goes to the client and says, hey, what if I sold you my bond that's paying 5%? How much would you pay me for it, considering you can only get 3% in the market currently? And that investor may look at Robert and say, hey, I'll pay you $11,000 for your $10,000 bond because I want the higher interest rate, right? So as interest rates drop, the existing bond becomes more attractive with that higher yield. And so bond prices increase as interest rates drop. And so that's the underlying thing that happens within a portfolio of bonds. That's why we said earlier in our bond portfolio, they may be paying 5.5% to 6% interest. But as interest rates come down, the underlying bonds inside of that portfolio are going to become more valuable, and they're going to appreciate in value, which is going to give us the higher rate of return, or the capital appreciation to go along with the interest rate, which is going to give us the better rate of return for the end of the year. So I touched on this a little bit. This is kind of what happened post-Fed announcement. And so you saw that the consumer price index indication of inflation came in a little bit hotter than what people were expecting. So the fear of the Fed lowering interest rates too fast, it's been my fear of if the Fed, and kind of why I questioned it with the health of the economy, why are we going with 50 basis point rate cut right off the bat? But if you lower interest rates too fast and you stimulate the economy too much, one of the fears would be is that inflation starts to come back in. And so what we saw was a little bit hotter inflation data than what we had thought we were going to get. And so a little bit of fear came in of, well, wait a second, did the Fed move too far too fast? And is that going to spike inflation on us and kick back up the inflation issue that we had back in 2022? And then the next piece of information that came out was the labor market. So the Fed has been saying for a long time that they wanted unemployment to kind of tick up. They wanted the labor market to weaken. That way, it would kind of justify their rate cuts and lowering interest rates over time. And what we saw was that the labor market actually looked better than what we expected. Unemployment actually came down more. And so, again, showing kind of the strength of the labor market and strength of the economy, again, begs the question of, did we need that 50 basis point rate cut at that time, considering the data that we're looking at? And so where the speculation started to creep in is, well, originally we thought we might get another quarter basis point cut, 25 basis point cut before the end of the year. And now people are questioning whether or not that's going to happen. Now, Jerome Powell has not changed his tune. He's still very much in the camp of that he's going to give us another rate cut. And probably, the market still tends to think that we're getting 25 basis points at the next two Fed meetings. But as this data continues to come out, people are starting to question whether or not that's the reality of the situation, and are they going to have to kind of change their trajectory or their decisions moving forward. Another key piece of information that we saw in the third quarter, which changed quite a bit, is that the international markets had a pretty significant adjustment. Most of that came from China. So China gave a stimulus package, and there's a lot of data on this slide, but basically rate cuts, bond buybacks, offering up money to start businesses and lend, and all these different things that China put in place to try and stimulate their economy, which has been struggling up to this point. And when that stimulus package came out during the quarter, we saw the stock market, or the Chinese stock market, rally in a big way. We had over a 20% run based on that stimulus information right off the bat. What that did is it really changed kind of the outlook for international investments. And it was one of the first quarters where we really saw international investments kind of outpace or keep pace with the US market. And now the question becomes, will that continue? So a lot of what we're looking at from the international space is this stimulus package enough to really stimulate the Chinese economy? And if so, is that going to change the landscape for the international markets moving forward? And should we adjust our portfolios to have more exposure internationally if this is going to stick? And if that is going to give the international markets a leg up on what we're seeing from the US markets, especially considering how well the US markets have done up to this point. Next slide, please. Oop, one back. There we go. So historically, if you look at this chart here, what we're showing is that the international markets have lagged the US markets in a big way. If you look at, let's move all the way to the right, the 10-year number. So the 10-year average, S&P is averaging around 13, developed markets, which are your developed international markets, averaging about 6, emerging markets 4. Even over the 5 years, 15, 8, and 5, 3 years, 11, 6. So in pretty much every area, the US markets have outperformed what we've seen from the international markets, except when you scroll over and you get to that third quarter. So the third quarter, S&P up 5.8, you saw developed markets up 7.8, and the international, or the emerging markets up 8.7. So a little bit of the changing of the guard in the third quarter. And the question and the research that we're doing right now is, will that continue? And is that something we should start to look at, and adjustments we possibly might want to make within our portfolios? This slide here, and it's a little outdated. This slide is from back in July, but this was, expectations of where these markets were going over the next 10 years. And a lot of what people are looking at is the US markets have done so well over really the last decade plus, that people and the return expectations for the US markets have been dialed back a little bit. And international markets that have underperformed they're starting to see opportunity or value there where we might actually see a period where international investments outperform US investments. And so you'll see the bar on the left is the 10-year expectation for US markets. They're saying 3.6%, where international developed markets at 7.5 and emerging markets at 9%. Now, this doesn't mean this is going to happen, but that's kind of the thought process that's changing a little bit recently, is that people are starting to say, have valuations gone to a place where the US market expectations are being trimmed? And there is opportunity international that we want to pay attention to and make sure that if that continues down that path, that we're taking advantage of it in our portfolios. And so the stimulus package from China is something to keep an eye on. There's a lot of people that believe it's not enough to really get China back on track. So we're going to kind of have to wait and see how that plays out. I will say that most stimulus packages, whether that's here in the US or in the international markets, you really don't see those numbers start to leak into the data for about 6 to 8 months after the package is kind of released. And so it's going to be a little while until we start to see the effects of that stimulus package on the Chinese markets. But it's something we need to start thinking about and paying attention to, because it's something that could present an opportunity for us moving forward in our portfolios. I'm gonna let you run with the election. Tired of talking about the election.
Aren't we all? Like I said, we can't be here in the now fourth quarter of the year with an election 2 weeks away and not talk about what's going on with the election and how we're paying attention to the effects of the election on the markets and on our investment portfolios. So if we just look at kind of the play-by-play of what's happened so far from the third quarter perspective specifically, we had the incident in July 13th, the assassination attempt in Pennsylvania. Then we have the Democratic candidate actually drop out of the race there in the third week of July. They've announced that Kamala Harris is to take over Joe Biden's position as the Democratic candidate or nominee. And then we had the first debate in September 10th. And all of these situations, all we can see is that it is a neck and neck race between the two candidates. And so what do we do as investment professionals and investment managers? How do we know what's the right approach, or what's the best odds to take as we look at the election's effect on the markets? And so if we go to the next slide, this is where we really start to analyze, well, in order to build a thesis on what might happen, let's look at historically what has happened. And so these three charts that you're looking at from left to right, the first is the first 6 months of presidency for Trump as the president, and first 6 months as Joe Biden as the president. And what it's looking at are the specific sectors within the stock market. You'll see we've highlighted a couple key areas, and those are areas where we saw a little bit different or opposite of a reaction than one might expect with those presidential candidates in office. So if we look at that first category specifically, energy under Trump actually went down about 12% in those first 6 months of Trump's presidency. And you're thinking, wait a second, here's Trump, he's pro oil, pro big energy, pro these energy corporations. How could energy sector be down in these first 6 months? You'd think they'd all be excited. And what typically happens is, their agenda is so pro oil in this case that it actually opened up so much supply that that sector lost a lot of its profits, lost a lot of its pricing advantage, and therefore actually takes a hit initially. And you'll see that pattern continue. If you looked in the next chart over, that's after the first 2 years in office, and then the chart all the way to the right is the full term of presidency. And you'll see under Trump, energy never fared well. It was kind of it was down the entire time. Now, keep in mind these are cumulative returns over that 2 and 4 year period. If we look at technology as well, that's the second highlighted area. Again, telling us a similar story where if If we look at the technology corporations, how they fared under Trump, how they fared under Biden, over those same respective periods, you'll see that initially it was pretty neck and neck, but over that longer 4-year term, technology finally did make its big play at the end of 4 years under Trump, initiating a lot of the corporate tax cuts, being very corporate friendly from a tax and economic point of view. And so we start to see those areas of growth. The only other thing too that I guess clearly communicates or falls in line with what we'd expect is, when there's a Republican candidate in office, typically we're looking at growth stocks being the biggest benefactor to that, and that's held true in each of these 3 areas. And then we look at Biden as the presidential candidate. You see value stocks really making the play and getting a majority of that growth. So that's something that's fairly well known in the markets, and our research held true as well. But this is the type of data that we're looking at to see, okay, as we look forward to this upcoming election, where do we want to be? And it's telling us we don't necessarily just want to be where we think the puck will be going. We want to look at, well, typically, historically, if Trump does win this election, as much as we might say we want to be big energy and align with his initiatives, from an investment management standpoint, it might not be the best play. So we're heeding advice there. Chris, anything to add?
No, I think the growth to value thing is important to note. And some of that comes with a lot of policies of, most would believe, and I think it actually comes up on the next slide. When you look at a lot of the ideas of what we're going to get, and you look up in the upper left-hand corner, Republican sweep. So if this is Republicans take all areas, Trump wins, the idea or the thought process would be that we're going to get big tax cuts. A lot of that's going to go to the big businesses. Technology is going to benefit from that in a big way. You're probably going to get some expanded tariffs, some issues internationally. So going back to our international talk, how does that affect that international play and what's going on overseas? A lot of those green energy subsidies probably go away. Whereas if you look over in the bottom right-hand corner to Democrat sweep, you probably got a higher top tax bracket. You've got some capital gains taxes and things to deal with. And if you go back to when Biden took office the first time, you saw a lot of we're going to spend on infrastructure and manufacturing and rebuilding here in the U.S. And so a lot of that industrial infrastructure type spending tends to lean more towards those value companies, right, and materials and whatnot. Whereas the Trump big tax cuts for big business is going to lean more in towards big pharma, technology, so on and so forth. So it's not hard to kind of read between the lines, but we just want to be able to see that and understand what is our playbook and how is it going to look depending on the outcome of this election. And using these two, what I've said a lot recently to people is one of the kind of nice parts about this election is we've kind of already seen both of these. We've already seen Trump as a president, so we have a pretty good idea of what his policies are going to look like. And Kamala has very similar thought processes. Is that a word?
I think so.
Yeah, to Biden. So we probably are going to see some similar, policies moving forward there. So it gives us a pretty clear playbook on how we might want to adjust the portfolios moving forward. Obviously, we're going to have to continue to do more research and see all of that. But these are all the types of things we're looking forward to prior to the election, so that once we know the outcome of the election, we already kind of know which direction we want to move with the portfolios. I'm going to talk about this one because I think this is super important. Market valuation. So what this chart is showing you, going back to 2020, is that line chart, when it gets into the blue area, that shows a market that is undervalued. There's opportunity there. Things are cheap to some degree, for lack of a better term. When it gets into that orange area, that's when things are pretty darn expensive. You're buying stocks at a pretty high valuation, pretty high price. Like Warren Buffett always said, I like to buy my stocks like my socks. I like to buy them when they're on sale and at a discount, right? And when you get into that orange area, those socks they're not on sale. They're actually more expensive than normal. And so the same thing holds true for stocks, right? We can look at valuations of the broad market and kind of understand where the market is currently. I'm one of those people. I never panic when it comes to investing or the markets. The markets, whether they go up or they go down, they have cycles. No matter how bad they drop, they always bounce back. So nothing really scares me or makes me nervous in the market. But it is important to recognize where the market is in its cycle and try to be able to make adjustments accordingly. Another thing someone asked me earlier is, if the market gets overvalued, do you move out to cash? No. I'm not an all-in, all-out kind of person. We're very much small incremental moves to try to weather the storm, stay invested. You never know really what's going to happen, but you do make incremental moves to the portfolio to try and reposition the portfolio accordingly and try to take advantage of what the market is giving you and what the data is telling you. And what we're seeing right now is this market is moving into that overvalued area. I don't know that it's quite there yet. You can see off to the left in 2021, it was quite a bit higher than where it is currently, but we are slowly making our way that direction. And I could see in the next 6 months, let's call it, us getting to a place where things are a little rich at that point. And so this is something we're watching because that would give us a reason to take some profits in some of those really growthy names, those things like the tech stocks that we all love right now that are great. NVIDIA, Apple, Netflix, these companies have done phenomenal. But there does come a time where you look at the valuation and you say, hey, maybe this stock is a little overpriced at this point. And so you take a little profits off of there, you trim back those positions, and then you look for value, and you go look for companies that maybe have a better valuation, and park some cash over there for the time being and let the market continue to adjust. So something we want to be aware of, and from the people that are listening that are clients, it's just to know that as portfolio managers, we very much recognize where things are going and when to make these adjustments. You might be seeing headlines right now of, is now the time to get out of the stock market? That's not my philosophy of getting out of the stock market, but you do need to know when to take some of those chips off the table and move them into different areas that maybe provide a little bit more value to you. And we're starting to see that creep that direction. And so that's something that is very much on our mind moving forward as we approach 2025. The Fear and Greed Index. Going back to another Warren Buffett quote, I say this quote all the time. His quote is, "Be fearful when others are greedy, and be greedy when others are fearful." And this is, if you can really wrap your brain around what that means, that's how to become a very good investor. And what that means is when the markets are terrible and nobody wants anything to do with the stock market, typically prices are low, valuations are reasonable, and I get giddy because it's like walking into a candy store where everything's on sale. You get to buy everything cheap. And most people don't want it. They're throwing away good stocks at a very cheap price. That's when I want to buy those stocks. And on the other side, when people get overly greedy or they think this run is never going to end, or everybody becomes a guru stock investor, I have to argue with people to sell some of their NVIDIA that's up 300% over the last 2 years. When people start to get greedy and you start to feel that within the market, that's actually when I get fearful and I start to think, hey, we need to trim some of this back because things are getting extended right now. And we want to make moves that protect us for that next pullback in the market. And as you can see, this chart that Eric in our office put together for us, we might not be in that extreme greed category, but we are definitely creeping that direction, which again, is no reason to panic, and there's nothing we need to do today, but it is something we need to keep an eye on over the next 6 months or so and start finding ways to take some of that risk out of the portfolio and stack some of that profit off to the side and look for valuations that are a little bit more reasonable in other names.
That's the one thing that stands out to me as I look at this, Chris, is 1 week ago we were in the extreme category. So it is throttling back and forth between, right on the cusp between those two. But most notably, if we look at 1 year ago, we were in extreme fear. And we're up 30 something percent from around that time at that point. And so to Chris's point, we usually like to play the opposites game. If you have a son-in-law or an uncle who's Nostradamus and has the exact holding that you need to be to triple your money in the next 12 months, that might be a sign that we're in an extremely greedy setting as far as the market's concerned.
Yeah, and it's not uncommon. I've had clients that call me up and say, "Hey, Chris, I want out of the market. I don't want to do this anymore." And that's typically when I try and convince them to put money into the market. And I myself will usually walk back to my office and go buy stuff. So when everybody starts telling you that you need to get out and the market is terrible, that's about the time that you want to put money into the market. And when everybody is like Robert said, everybody knows the exact position you should own, and everybody's starting to trade their own money and they're making money hand over fist and they think they're a genius, that's when I start to get a little bit worried, and we want to start, reducing some of that risk within the portfolio. You want to take it?
And I mean, I'm happy to. Let's just go ahead and jump to the next slide because it's kind of a lot to take in.
It's really first, before you go there, real quick.
Yeah.
This is for business owners, and this is kind of our public service announcement. Doesn't necessarily have to do with anything that we do in our portfolios, but it's definitely conversations that we've been having with our business owners to make sure they're aware of it, because the penalty is severe and it is brand new and very few people are talking about it. So I wouldn't be surprised if you're a business owner, if you have an entity, LLC, S Corp, anything like that, that you might not have heard about this and you might not know about it. So we want to make sure that we're bringing this to your attention and making you aware of what you need to do in order to avoid the stiff penalties that go from lack of reporting this information.
Yeah, and exactly right. Especially if you aren't working with a reputable attorney on your corporate bylaws on a regular basis. Especially for those who set up a corporation online on any one of the websites that allow you to do it for $100, you're held to the same standard as these large corporations. And so what's really happening here is FinCEN, the institution, they are enforcing this beneficial ownership reporting. And so what's happening is Congress wants to know who are the beneficial owners of every corporation legally filed in the United States of America. And so who has to report? Anybody with a corporation. And so if you have an LLC, if you have an S Corp, a C Corp, you have to go through this process and report. And there's the website address there in kind of dead center of the screen, www.fincen.gov/BOI. And what you have to do, it's a relatively simple process. You go there and you complete the information of, hey, who are the participant owners of this corporation? Now, you need to do this. Depends on how long you've had the corporation, when you filed the documents. But I guess suffice to say that no matter if you open an LLC today, you by the end of this year need to complete your beneficial ownership reporting and go through that process. Like Chris mentioned, the penalty is rather severe. It's $500 a day that you do not complete this going into 2025. Now, keep in mind that number is also adjusted for inflation. So you'll see there in that last sentence that would be closer to about $591 a day by the time those fees start to accrue. And so very important. No one is talking about this, and we wanted to make sure to bring it to your attention. If you need help getting it done, there's attorneys that we know that can help with it. There's bookkeepers that we know that can help with it. And if your advisor really likes you at Prosperitas, there's probably a way that they can handhold you through it too, because a lot of us have had to do the same. So feel free to lean on your resources around you if you feel a little bit overwhelmed about this process. But we want to make sure that you know about it so that you're not paying $3,000 a week for every week that goes by.
Crazy. Yeah, the penalties are stiff. Couple things to note. If your entity was created prior to January 1 of this year, you have until January 1 of 2025 to file this information. So if your entity's old, you have until the end of the year to get it done. If you started a new entity in 2024, you have 90 days from the day that you started that entity and filed that organization to fill out this information. And in 2025, so next year, just so you're aware, if you form an entity in 2025 and beyond, you have 30 days from the day that you file that in order to put this information in. So this is not a one and done thing. It also triggers every time you make a change. So if you change any of the ownership within the firm, all of that needs to be reported on a regular basis. So long story short, if you have entities or an entity, you're going to want to stay on top of this and make sure that you understand these rules and that you are filing this information whenever you need to avoid these very, very stiff penalties. Let's wrap it up. Let's summarize. So what you're going to hear me say a lot, and you can leave this up there for the people that want to read any of this information.
I think the camera's on you, my friend.
Is it on me?
Yeah.
Oh, well, lucky you. So let's wrap it up. So one of the things I say a lot is that, and Robert made an excellent post. If you don't follow Robert on social media, you should go check out his social media. He posted a bunch of information of people that are over the last couple of years have told you what was going to happen with the stock market, and they've been wrong. A lot of people try to predict what the future is going to look like. And the fact of the matter is none of us really know what is going to happen moving forward. That's why we manage portfolios the way we do. We try to adjust and pivot based on new information, manage portfolios for the long haul, but we never try to say we know exactly what's going to happen. And one of the things I say a lot is what I think is going to happen today, I may have a completely different opinion tomorrow based on new information that is given to me. So it's a constant, updating of information and making sure we're staying ahead of that information, and we're constantly adjusting our portfolios and our ideas and our thought process on a regular basis based on new information when we receive it. That is my disclaimer. But I will give you a little bit of what I think I see coming, is that while I think valuations are stretched, I do think this market has some room to run, and this market really loves when the Fed is lowering interest rates. If you go back to 2008, when the first quantitative easing program came out, this market is somewhat obsessed with and addicted to the Fed and what the Fed does. Another line we use a lot is don't fight the Fed. So when interest rates go down, the markets tend to go up. And when interest rates go up, like in 2022, the market goes down, and it tends to kind of follow that suit. So with a Fed that has an agenda of being more lenient and flexible and lowering interest rates, that is a good setup for the markets. And so we might still have a little room to the upside here before we get to that really extreme greed and overvalued area like we've seen in the past. So there might be some room here. That may last another 6 to 8 months. We'll have to see how that goes. So I still like what I'm seeing from the markets currently. I also think that regardless of the outcome of the election, post-election tends to be good for the stock market. So I think that is also a bonus. And I've said time and time again, the best months historically for the stock market are November through March. So get the election done. You have a potential good seasonal environment for the stock market. You got a Fed that's talking about lowering interest rates. All of that sets us up for a market that probably looks like it's still set up to run a little bit further. And there's still a lot of opportunity in the market currently as it sits. When I talk about worrying about valuations and stuff like that, I think that's probably a spring, summer of 2025 thing where we're going to have to worry about that. We'll see how it goes. But I do think there is a landscape here for the markets to continue to do relatively well. And as far as the bond market is concerned, We talked a little bit about the Fed and people questioning what the Fed's path is going to be moving forward based on some of this new data. I still think the Fed is definitely moving the direction of lowering interest rates. And if I had to guess where interest rates are 12 to 18 months from now from versus where they are today, I think that is still lower than where they are today. So we'll have to see exactly how that plays out, but it does look like the Fed's agenda is still to lower interest rates over the next year or so. And we'll probably learn more at the next Fed meeting, but that does look like the intentions and where we're going. So, just to kind of clarify where we think things are going, we still think there's a lot of opportunity here, but we do want to pay attention to how the election turns out, what the Fed says over the next couple of meetings, how that economic data continues to unfold over the next 3 to 6 months, and where those valuation numbers tend to go for adjustments we might want to make to the portfolio over the next 6 to 8 months, let's call it. But all in all, I hope the underlying messages, things have been very good this year. They were very good last year. They've been very good this year. We've made a lot of money in our portfolios. All of our portfolios have really done phenomenal. And so we don't expect that to stop anytime soon, but we want to be mindful of making sure we keep some of that and lock in some of those profits for you guys and make sure we protect if things are going to change at some point in the future.
Yeah. Love that. Quick couple things on housekeeping. One, let's see, we put out a quarterly letter as well. That's similar to what we've shared in the webinar. It goes a little bit deeper into specifically our flagship fund. So that is available. If you haven't seen it, or if you would like a copy of that, reach out to us, info@prosperitasfin.com, or reach out to your Prosperitas Financial advisor. We'd be happy to send that to you. Number two, just want to thank the investment management team and Eric Abrahamian for putting this research together. I mean, there's no way we could report on this information. Our webinar, the quality of data that we could jam into our webinars was a fraction of what it is today. So Eric, thank you for piecing this together. And if you have any questions, reach out to your advisor at Prosperitas. If you're not already working with an advisor at Prosperitas, send us an email at info@prosperitasfin.com. We'll get you matched up with the best fit in our office, and would be happy to just answer questions and be a resource for you. So.
Yeah. And the last thing I'll throw out there is typically somewhere in this fourth quarter coming up, Santa Claus tends to visit our offices, and we invite the kids and the families out to come take pictures with them. So just keep an eye on your inbox. You'll probably see something coming out, once we know more what his schedule looks like and when he plans to visit us.
Exciting. Thanks so much for joining.